Hey guys, Akil Stokes here. Wanted to pop up and share with you a quick video with the topic of trade frequency and finding the balance between valid signals and false signals. I'm also going to walk you through some simple math that hopefully will give you a fresh perspective on how you think about win percentage. So this morning, like every Monday morning, we had one of our private Q&A sessions with the traders that I work with over at tier1trading.com. The conversation started with a question about how to better enter trend continuation trades, and that led us down the trading rabbit hole of dealing with multi-time frame analysis, specifically how to use a lower time frame in order to get a quicker reason for entry. Now, when this came up, one of our veteran traders hopped in and just gave a great reminder to our group that on the lower time frame, it's important to remember that although it's a quicker signal, you're also going to get a less reliable signal. And that's definitely something that's worth keeping in mind if you're going to be popping down to lower time frames. Now, what I want to do is I want to share with you a quick clip from that Q&A session, sharing with you kind of a conversation we had on the pros and cons of more signals versus more false signals. I'm also going to pop back in and show you some cool math talking about expectancy and how this can relate to your overall strategy's performance when it comes to the balance of trading more versus trading less, high win percentage versus low win percentage, and again, hopefully change your perspective on how you think about that. But we'll dig into that later. So let's hop into that first clip and I'll see you guys in a little bit. But it's also a common problem because we want to trade. And we want to find a reason for trading. And if we look hard enough, we will find a reason for trading. Yeah, so I'm not saying lower time frames are bad, but just keep that as understanding. There's the pro and the con of everything. The lower the time frame you go, right, you're going to get a more signals. But you're also going to get more false signals, right? It's the same thing with the RSI, right? Here's a good example that I can give you. If we look at my relative strength index down here, right? This is my RSI. My period is 7, right? I'm going to actually bring on another RSI so I can show you an example of here. RSI. Bang. Here we go. So I got two RSIs. One is prettier than the other, right? Mine is prettier than the other one. But let's kind of get this out of here. No one cares about that stupid moving average. So up top here is a 7-period RSI. Down here is a 14-period RSI. So right in here, you can already see that the higher one, right? The higher RSI, but the lower the number of RSI, already gives me a signal that my other one doesn't have, right? We have an oversoldness right here on the 7-period that we don't have here on the 14-period. We have two overboughtnesses, is that a word? Here on the 7-period. No overboughtnesses here on the 14-period, right? If I want to get crazy, and go to like a 5-period RSI, which is what I use for my my range bar charts, just look at this. Look how many overbought scenarios I have in this time section. Let's count them. I have an overbought right here, 1. We're not going to count that. I have over 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 overbought or oversoldnesses on my 5-period RSI. On my regular 14-period RSI, 1, right? So again, more signals. I'm not saying it's better or worse, but for the example, we're talking about I have more signals. So if I am someone that has a trading strategy built around the RSI, right? And that trading strategy is built around the RSI, either breaking above the overbought or oversold or hooking back below the overbought or oversold, whatever it may be. On a shorter period RSI, I've gotten a lot more signals. However, as we mentioned before, which started this whole conversation, a lot of those signals are also going to be false signals. There's a lot more false signals. Now, I'm not saying that's better or worse, because there's a balance between trading frequency and win percentage and risk reward that makes up your edge, right? So a trader, again, here's a good example from a while ago. I told you the story a million times. I'm gonna tell you again because I'm old and I repeat my stories. Brilliant trader I worked with, doctor out of France, who was living in, where was he living in? Gosh, I forgot where he lived now. But anyway, brilliant mind. He created, we brought him in, we had a live meeting. It was a mastermind group meeting. We brought him in because we had a coder and we were doing a lesson on how to develop a trading strategy and code it to make it automated so that you don't have to be in front of a chart and you can just do whatever you want while your system makes money. And he had this strategy and he's walking us through it. And it was this strategy that was like 90% correct, guys. I'm not lying. 90% correct. 9-0, right? Crazy. How many of you guys would love to trade that? Give me a yeah. 90% strategy. Without knowing what I'm about to say next. Because I'm leading you down a cliff. I'm walking you to a cliff, right? You're going to fall off. But just before, just pretend the cliff isn't there, right? Yes, we would all hands go up. The problem was it gave 2 entry reasons a year. There were so many filters in there that it only created 2 entry reasons. Now, let me ask you guys this. How many of you guys would want to trade something that gives you 2 trades a year? Think about the pressure. Imagine you happen to get sick. On one of those days that trading opportunity comes, or you happen to be maybe not by your computer because you went 300 days without getting a signal and you're like, I'm not waking up 6 o'clock today. What are the odds of this happening, right? 2 out of 365, right? And then you miss it. Or think about all the psychological trauma that you would go through as you stare at your chart for 365 days and 362 of them or 3 of them don't have any signals. Think about your trading, right? We spoke about that in the last Trading Coach podcast about boredom and how it leads to trading mistakes, right? So I would bet that you would probably, and again, you would need all the numbers to determine this, you would probably value a trading strategy that had a 60% win rate that offered 200 trades a year versus a trading strategy that had a 90% win rate and offered 2 trading strategies a year, right? The 60% one would probably be more profitable. So again, that's the balance. So we're not just doom and gloom and saying, hey, lower time frame bad, more frequency bad. It's all about that balance. The thing is, you have to be aware of it and you have to accept that. You have to be like, hey, I'm gonna take more swings, but I'm gonna miss the ball a little bit more. Versus I'm gonna take less swings, I'm probably gonna hit the ball more, but I'm gonna take less swings and more opportunity. Now, if you present most traders with the idea of a 90% win percentage, you're jumping out of your chair, you're throwing stuff against the wall, you're having a party because yes, the holy grail has been found. But when I then tell you about, hey, this 90% win percentage only comes with a handful or less than a handful, a half handful of trading opportunities per year, you probably may have a little bit of pause. So on one hand, you may be thinking, I don't know if I can do that for the reasons that I mentioned before. Or you may be saying, you know what, it's still worth it. And I think this is the perfect opportunity to talk to you about why win percentage doesn't matter all too much, or rather it's only piece of the puzzle, meaning that sometimes having a lower win percentage with higher trade frequency can actually be a more profitable situation than having a higher win percentage with low frequency. And to do that, I want to walk you through something called the expectancy module or the expectancy formula. And I promise I'm going to dumb this down as much as possible. If you guys are familiar with the expectancy formula, don't go throwing a fit if it's too dumb. What I found in my experience, especially with the YouTube channel where we have a lot of newer traders, is that if I make things as simple as possible, it is the easiest to understand and you don't get overwhelmed and scared, because a lot of people are scared of numbers and math and trading in general. So what is the expectancy formula? Well, I'm going to put up a chart, hopefully that makes the math a little bit easier for you, but I'll try to explain it as well. Pretty much what you're doing is you are taking your win percentage times your average win, and you are taking your loss percentage times your average loss, and you are doing the sum of that first number minus the sum of that second number, and what you will get is a number. Now, 0 is kind of your middle ground. Any number above 0 means profit. Any number below 0 means loss. The higher you are above 0, the more profitable your system or strategy is. The lower you are below 0, the worse your system or strategy is. Now, for today's purposes, we're going to make this extremely simple. So we're just going to take kind of a dollar figure. I'll make the math easy for you, but you would do the math however you feel is fit for your system or strategy. So in this example, what I want to do is I want to show you a comparison between kind of, I guess, a average trading strategy versus a trading strategy that wins 90% of the time, and show you how, well, I don't want to spoil it, but how one may not be as great as you think when you look at the entirety of it. So let's start with the first column, or the first section between the parentheses, which is going to be our average win, or our win percentage, times our average win. Again, we'll simplify things. Let's make our win percentage 50%. We are a 50% trader. We are going to have an average of 2-to-1 risk reward. So let's say that my win percentage, is 50%. And let's say my average win, we'll make it simple and put it in dollars, is going to be $50. I'm going to, that number is going to give me 25. So take that number 25 and store it underneath that section. We're then going to take my loss percentage, which is also 50%, because if I won 50% of the time, I need to lose 50% of the time. And we're going to times that by $25, because again, I told you in this model, we're doing a 2-to-1 risk reward on average, right? That number is going to be 12.5. I'm then going to take my, 25, and I'm going to subtract 12.5 from it. And that's going to give me a number of 12.5. So that is the expectancy for average trader A. Let's do the same math with 90% trader, right? So obviously for a 90% trader, our win percentage is going to be 90%. We're going to times that by the same $50 win, and that's going to give me a number of 45. So let's stash that under there. Our loss percentage, if we won 90% of the time, we'd lose 10% of the time. So my average loss is going to be, or my loss percentage, is going to be 10, right, for 10%. And my average loss is going to be 25, because again, same 2-to-1, keeping everything even. Half of 50 is 25. That's going to give me a number of 2.5. So I'm going to take my 45 and then I'm going to subtract 2.5 from that, and that's going to give me a whopping number of 42.5. So right then and there, you can see there's a big difference, right? Number A was 12.5. Number B was 42.5. Remember what I told you? The further away from 0 we are, the more profitable your strategy is. So strategy B is much more profitable than strategy A. But here's where frequency and opportunity comes into play. Remember that I told you this 90% trading strategy only offered 2 opportunities a year. So let's take that 42.5 number, let's times it by 2, and that is going to give me 85. Now, if we were just to have, I'm trying to do quick math in my head now, 7 trading opportunities with the option A, that would give us a number that is higher than number B, right? That would give us 87.5, which is higher than 85. So you can see that although strategy B had the higher expectancy, because the frequency was so low, that if I simply had a higher frequency with strategy A, let's say I got 10 trades a year or 20 trades a year, right? That is actually going to produce me more profit than strategy B, right? So it's an interesting dynamic. I know we think win percentage is the best, but we also need to scale. If putting this into a business perspective, this is the same situation as having like one store that is profitable versus having 10 stores that are technically less profitable, or none of those 10 stores are more profitable individually than that one store, but as a whole, they are. And this is something that we need to think about in trading. We've done plenty of Trading Coach podcast episodes where we've spoken about how to grow your trading like a business. I'll link a few episode links below. But we talked about increasing your frequency in a few ways. One, by adding the amount of assets that you trade. So instead of just trading, for talking Forex, one pair, see if you can trade 10 pairs because you're automatically going to increase your frequency that way. Another one is increasing the amount of strategies you trade. You may trade one strategy for positive expectancy with a very low frequency. Maybe you don't want to mess that up because it's very specific. Well, now you can add more trading strategies to that and you can increase your frequency that way. Or you can do both. You can trade more strategies on more pairs and increase your frequency that way. Now, not to get too deep down that rabbit hole, but you do have to take risk management into account, right? If you're trading a very high risk per trade, the more frequency you have and the more overlapping trades you have, the less you can afford to risk because you put yourself at more exposure. But again, just keeping all things equal, because I want to keep this simple, I hope you guys are able to see how it's not just about the best performing strategy being the most profitable strategy, but it's a kind of a combination of good performance plus good opportunity, and that's how you can grow your trading business. I hope that made sense. I kind of rushed this. You guys know I don't pre-plan these videos. I put the microphone on and I just spew from the mouth. But if it did, let me know below. And if it didn't, let me know below as well. That way I can maybe redo it in a different way or maybe answer any questions that you may have. Lastly, because I don't do this nearly enough, if you are interested in joining these regular conversations that we have on the Tier 1 trading platform, head over to www.tier1trading.com. Check it out. There's a 14-day trial membership, which gets you access to the platform. You can hop in live rooms, you can take courses, you can download software, and it's risk-free. So that means after 14 days, there's no auto bill or anything like that. You're simply kicked out. But we do that because it gives you an opportunity to kind of make sure that we're the right fit for you as far as our teaching style, as far as our coaching style, as far as the community goes, before you make any type of investment, because that is very important that you find the right fit, because everyone's a little bit different when it comes to their trading and honestly when it comes to their learning. All right, hit that like button, subscribe if you're not already. I got more videos coming your way this week. And until next time, plan your trade, trade your plan. Take care. Ooh, how about those toffees, baby? Woo!